Welcome traders to today's educational video. Now, if you're a new trader and you're still struggling towards the path of profitable trading, then this video is specially for you. Watch this video till the end to understand the four most common mistakes in trading. Now, normally there are many mistakes which a trader can actually commit in his trading process, but in this video, I'm going to share the four most common mistakes in trading. All right. So without any delay, let's start the video. Now, as you can see on my screen, I have made a small mind map for all of you, and I'm going to go step by step towards each and every mistake. So watch it patiently. So the first mistake which you can see in front of your screen is trading against a trend. Now, what do I mean by that? First thing is, normally what professional traders do is they buy when the stock is going up or when the index is in an uptrend, or they short a particular market when the stock or the index starts a new downtrend. But normally people who are absolutely new to the financial markets and they do not have any knowledge or any ideology towards trading, what they start doing is they start buying stocks or an index when it is going down, and they keep on buying the dips when the stock is going down, which is terribly wrong. I'll share with you a small experience. Now, on this screen, you can see the stock Tata Motors, correct? Now, this is somewhere in Jan 2020, and this bottom was made in March in a matter of 3 months. Now, the peak of the price is somewhere around 200 rupees and the bottom is somewhere around 64. So now, one small thing, suppose in case if someone buys the stock at this level, thinking that from this level we have seen a very big bounce and probably this is a strong support and I should buy over here. All right. That is the logic if a person applies. All right. Now, if the trader has bought the stock at 160 and the stock goes up little bit and then starts coming down, what should one do? That is most important. And normally, if you see properly, from 200 rupees to 160, the price was coming down. It was not going up. The trend was down. If you buy the same dip at a support when the trend is up, probably the entire outcome of the trade would be totally different, right? So if you buy over here, you're not making much money except this small bounce which has come. If you buy somewhere over here, say at 146, you're still losing money. If you're buying at 130, still the stock is going down. You can see consistently at 106, you're buying, stock is going down. Buying at 87, you're losing money. Why? Because the trend, the direction of the trend is, the direction of the price is on the downside. Now the same stock, if you try to buy when the trend is up, I'll share with you a small tool which is called the trend line. I hope all of you would be knowing this. In case what a trader does it, a simple thing, suppose if you're in an ideology of buying dips, then you need to buy those dips when the trend is up. In case if you try to buy somewhere over here, say at 101, if you would buy when the stock is down, you're losing money. The stock is going down by 20-30%, and from the top is that it has collapsed by over 50%. But the same thing, if you buy over here at 101, 102, you can see the rally going on till 155, nearby a 50% profit in a matter of few months, correct? Same stock comes down, retraces and possibly hits around 127, and from 127 you can see how nicely the stock has tested 183. So this is one mistake which normally amateurs do, and I think this should not be done, because this is the first and foremost mistake which I've seen in many traders. They try to buy when the trend is down, thinking that the stock is available at a cheaper valuation or whatever the thought process is. But ultimately, if your timing is not correct, you might not be able to make money. Now, the second most mistake which normally people do is not following stop losses. And in that, I would add a little bit more, keeping very small stops. Now, I have seen people, when I interact with many traders, what they think is that when you have a trade in front of you, you should be buying huge chunk. if you're trading in options or futures or cash market, they will try and buy a huge chunk of that particular stock or index, and they will keep a very small stop loss. Now, the logic behind keeping a very small stop loss is that they think if the stop loss is very small, and if they have bought a very big chunk of that stock or an index, and if the stock, if that particular trade goes into a profitable trade, gets converted into a profitable trade, they will be able to make a very huge amount of profit. That is true. But normally the probability is, if you're keeping extremely small stop losses, uh, most of the time your stop losses will get hit. And I've seen many traders that they tell me that, sir, it is not important to keep stop losses because most of the time my stop losses are getting hit. But that is not true. Keeping stop losses is an art. You should know exactly how to do it. And one another thing I would also say is, if you're going to buy a very big chunk, then automatically you will keep smaller stop losses because you don't want to lose big money. So the key over here is to buy a decent amount, not very small, not very big, but a decent amount, and give some space to your trade to move up and down, because it is not necessary once you initiate the trade, immediately the trade will go in your favor. If you see the chart of Tata Motor, once again, if you see the stock somewhere over here, all right, the stock has tried to go up, again it came down, then it went up, correct? It's not like once it tested, immediately it took off. So that generally happens very rarely. So you need to give some space, and you need to know that stop losses are very, very important. And coming back to the point, in case, let's say, let me take an example for you. Let us take a very good example which makes sense. All right. Say, for example, if someone tries to buy Tata Motors. I'm sorry, there's something new opened up. Okay. So someone tries to buy Tata Motors at this particular support. All right. I hope now this is very clear. Now, this is the support. It gets retested over here. All right. And the person thinks that this is probably a start of a new uptrend. All right. This has happened later on. This has happened later on because the chart was looking like this. So a person thought I would try to buy somewhere over here, which seems probably logical. But after buying, if the trade does not work out, you need to keep a stop loss, probably somewhere below this, an aggressive stop loss. But I would always say give some room to your trades to, move on. You can keep just below this low. And once if this stop is triggered, and if you would come out at this particular price at 387, you can see how much down the stock has corrected. So yes, you will make a small loss, a very small loss, but it's going to save a lot of money in your trading account, because eventually from 387 you can see the stock has gone till 247, which is a very big move on the downside. So keeping stop losses is very, very important, and that is what normally amateur traders do. They don't follow stop losses. So please don't do this mistake. And averaging losing trades. This is something which is the last thing to ever do if you are a trader. So basically, if you have not kept a stop loss, all right, and the stock is going down, at least do not average your losing trades, because what I believe in, pyramiding profitable trades. If you buy at a certain price and if you add when the price goes higher, all right, you are going to make more money. That is called pyramiding profitable trades. Let's check the chart of Reliance Industries. Right now, the recent rally which has happened in Reliance Industries, you can see the stock has started going up after making the first higher low. This is the low at 867. This was higher low, and then this price started going up. Suppose somewhere over here you buy at this 1500 level, just in case, and then the stock starts going up and you average it even further. Suppose you have bought an X amount of quantity somewhere around 15.8 or 15.17, and the stock goes higher at 1615. You add a little bit more, and you can see that the stock is rising. So even if you're buying at a higher price and if the trend is up, probability is that you will be making more money in your that particular trade. And the same stock, if you buy somewhere over here, the stock drops down, bounces back, and still if the trend is not up, and if you add somewhere over here, chances are that you will lose money in the same stock just because the trend is down. So do not average losing trade. This is a deadly mistake. This could possibly multiply your losses to a very large extent. So always follow stop losses. And if you have not kept a stop loss due to some reason, if you are new to the market, at least do not average down your losing trades. This is a deadly mistake. This could possibly at times even wipe out your account if you're trading in derivatives, especially. And if you're trading in cash, and if you have traded a very big chunk in in one single stock of your entire trading account, even that is very, very dangerous. And last and not the least, over trading. Now, over trading is, I would consider also, as you can see, I have written over here, different form of greed. And why is that? What I believe is, even if you are a short-term trader, like I'm a trader who trades in options and futures in short term from 1 to 3 days in options and around 1 to 5 days in futures. And for cash market, I generally trade the daily chart from 1 to 3 months, 1 to 4 months in delivery trades. So when I am trading, generally, I plan my trades well in advance, and I don't like to trade or initiate too many trades in a single month. But if you think that the more you trade, the more money you will make, on paper, it looks realistic, but in practical life, probably it will not work, because most of the money will be made when you plan out your trades well in advance and you understand where the index is going, where that particular sectoral indices are going, how a stock is looking. Is there, first of all, the most important thing, is there any probable trade as per your trading setup or not? If there is no trade, just because you are sitting in front of your laptop and in live market, suddenly the stock starts moving and you punch the button and you buy that particular stock, don't do that. Plan your trade well in advance, trade less, try to make more money out of lesser trades. Probably you will have lesser stress in your trading career, and overall result of your trading would be much more better. And this is what I'm telling from my own experience, because when I started my career, obviously even I have done few mistakes, and no trader possibly starts their career with complete flying colors, and this is the truth. All right. So I hope you liked my today's educational video, and I hope this will help you a lot. If you find that this video is really helpful to you, please try to share with others. They will also benefit from this video, and try to comment below in the comment box and let me know how did you find my video. And I'll try to share even something more important in my next educational video. Till then, trade well.